Hello guys and welcome to another DeFi video. Today taking an in-depth look at Palantir Technologies, an American publicly traded company that specializes in software platforms for big data analytics. As of the 2nd of February 2025, the stock price stands at $82.5 with a market cap of 188 billion. Their trailing 12 months price to earnings stands at 412 and their 10-year median P is nil because they've had a negative P for years. Their price to cash flow is 189 and their forward dividend yield is 0. Their revenue has increased by 199% over the past 5 years. Their net income has increased from negative 580 million to positive 209 million. Their earnings per share have grown from minus 1 to plus 0.09. The common shares outstanding have absolutely exploded by 316%, so they've absolutely destroyed shareholders with this dilution. Their interest coverage ratio is 104.3, so basically they have almost no interest payments. Their quick ratio is 5.67, so they have extremely good short-term liquidity, and they have no debt, so their long-term debt to equity and debt to equity ratios are both nil. Next, cash from operations. Cash from operations has grown from minus 165 million to plus 700 million. Cash from investing has increased from minus 22 million to minus 2.7 billion. Cash from financing has decreased by 32.7%, and capex has increased by 15.4%. Free cash flow, most important of all, of course, has increased from minus 450 million to plus 700 million. The financial ratios also look pretty okay. The return on equity and return on assets are both at around 6%, although they will increase very fast since their margins are increasing pretty fast because they've only recently became profitable and now their margins are increasing at an accelerated pace. The return on equity is 0 because they have no long-term debt and we can calculate ROI, and the return on invested capital stands at 47%, which is extremely good. I calculated their intrinsic value from DC valuation, multiple valuation, and analyst expectations. I applied a 15% margin of safety, and I got an acceptable buy price of $21.71, suggesting that the stock is currently massively overvalued. Now, to wrap up my analysis, I believe that Palantir is a very well managed company. I know that their stock valuation is extreme, but they've done that because realistically speaking, if they would have taken out debt, especially in the last 2 years, they would have been paying insane interest payments and they wouldn't have the capital to invest. They would just have money that would have to actually go back to the banks in interest payments. So by taking money from shareholders, they're actually doing the shareholders a service. But to be honest, it is still a bit too much. I mean, 40% CAGR in common shares outstanding is absurd. It's like it's a criminal pace of dilution. Of course, they've slowed down considerably in the past 2 years, but still, it's out of dilution, and I believe that this is a big problem. This is one of the big problems because I hope that they'll completely stop with this dilution because it's absolutely destroying the company from a shareholder point of view. If they completely stop it, that's great. If they don't, that's a big problem. And even if they don't, we then move on to the next problem. And the next problem is that they're insanely overvalued. I mean, trading at a 400 price to earnings is absurd. They're not growing earnings at like 100% per year. And even if they were growing earnings at 100% per year, they will still have many years until they reach the good valuation. Because if, for example, their net income uh, increased by 2 times every year, then it would take about, I think, 6 years. So wait, let me calculate. So the first year they go to a 200p, the second year to 100, the third year to a 50, the fourth year to a 25. So basically, only after 4 years of continuously doubling their net income would they actually go to a good or tolerable price to earnings. And they're not growing their net income at 2 times, they're growing it at 30% CAGR, which means that they just do not deserve this price to earnings also and their price to cash flow. Now, they're great companies. I've said before, they're growing very fast, but this is I just don't see any value. They are absolutely destroying shareholders with dilution. Now maybe the company is doing well, but the shareholders aren't. If they continue with this dilution. Um, yeah, I believe that maybe I don't know if they drop to 25, they're a buy, but until then, yeah, this or maybe even 30. If they stop the dilution and actually focus and actually increase their margins even further, yeah, I think 30 might be a good buy price. But yeah, the current buy price, the current stock price is absurd. I mean, sure, today's market, everything is overvalued, but there are still opportunities out there, even if they're slightly overvalued. This is just absurd. I mean, if this is like 6 times more overvalued than Nvidia, we are literally in the 2001 bubble with this stock. So yeah, I think that's going to be it for today. Also, do not forget to check out our affiliate, Ticker Data. Ticker Data is a great tool for Excel, for real-time financial data, and also for personal templates. So if you want to do a DCF or a DDM, or you want to track your own portfolio, you can use their API. It's you can check it out in the description. There, I put there a link, and yeah, I think you'll love it. It's also pretty cheap. Also, not forget to check out my investing blog from the link in the description below. Hope to see you in the next video. Bye.